Hey guys, Boris Lasser, BK Forex. Welcome to our Forex Weekly Technicals for 09/29/10/3 of 2014. Where are the trades? Well, the trades clearly for the last week have been in the pro-dollar camp. The dollar has just been a juggernaut of trading. As you can see, the euro coming down all the way to taking out the 28s, taking out the 27s today. And now the only thing that stands in front of the euro is this 26.60 support level. There's tremendously negative sentiment against the euro right now, and it certainly has a tremendous amount of momentum. But it's also at the same time, I think, viciously oversold. It's very, very tough to pull a trigger to get short of this at this point. And at very minimum, if you're sort of buying the 26 to 2600 as, excuse me, 2600 to 2660 as kind of a bottoming out area ahead of the 2500, you may be able to get a little bit of a short covering bounce at least for the next couple of days. Still, euro very much remains a sell on the rallies trade here. But chasing it down to this level just feels, it may very well be the right trade. It just feels extraordinarily difficult to pull the trigger to get short here at this level. Perhaps maybe that's exactly the reason why you might want to get short here. I still think, though, the 2600 to 2660 probably represents a pretty decent value proposition, given the fact that we did take out the lows here today, and certainly we probed this 2700 very, very hard today, but really weren't able to make much of a push beyond the typical 25 cents below the 00 level as we spend the rest of the day kind of hanging out here. Next week is going to be a key tell. I think certainly they're going to want to run the 2650 level, but at 2650, that's really going to be an interesting tell as to whether there's going to be any kind of buyers coming out or whether this is just going to fold like a cheap poker table or a cheap card table and just come down all the way out to 2500. I still, looking at this, makes it very, very difficult to want to get short here, but the proof is in the pudding. It's certainly been a one-way trend to the downside, and trying to buy this thing has been a very, very painful experience. In dollar yen, the story is quite a little bit different here, and I think this is a kind of an interesting tell here, perhaps where the dollar may be slowing its momentum, because the 109.50 represents a pretty strong resistance level, and we have not been able to clear it, even with all of the pro-dollar movement that we've had over the last week. This kind of one day up, next day down, one day up, next day down, is emblematic of at least a short-term topping pattern. Now, 110 is very much in sight, and if there is some kind of a positive economic factor that happens next week that convinces the market that we're definitely going to hike sooner rather than later, 110 may indeed be very well taken out. But as you can see, ahead of the 110, which has been the big resist area since 2008, we've had a very, very strong battle. There's a much stronger battle here in front of the 110 in the yen than there is against the euro, which is both going down because of dollar strength and euro weakness. Here, in this case, you just simply only have dollar strength trying to drive the whole thing. And plus, you have U.S. yields not really cooperating as much as you would want. I mean, we're still essentially at 2.5 on a 10-year. That's hardly gives it a huge impetus for dollar yen to want to rush higher. So bottom line is, this 109.50 area is certainly a very, very big resist area. We'll have to see how well it trades and whether it can actually close above that in order to give us confidence that they could make a run towards the 110. If we can't have another day where we sort of fail around these areas, then the next level to look at is the break of the 108.50s. The break of the 108.50s would really signal a much cleaner and closer topping formation, with a correction probably all the way down to probably 107.50 to 107. So for now, both ends of the range look very, very promising, but I think you have to be patient enough to see whether we can hold the highs at 109.50 or break the lows at 108.50 before you can commit to a directional move in dollar yen. Pound dollar crushed again today with all the anti-dollar flows here, and it's actually interesting, the pound dollar really ending on the lows of the day today, despite the fact that if you look at it fundamentally, basically, it looks to be that the UK central bank is probably going to hike at very minimum at the same time, but quite likely before the Fed. And that would certainly give cable a little bit more bid than you would think. But there was a tremendous amount of selling across the board in cable here today. And we took out the 62.50 support level, which was a key support level. And now, of course, the one really big support level here that stands for cable is the 62 level. Cable is notorious for being very volatile and running through its support levels and its resistance levels before it kind of stabilizes. So I think, given the fact that we've had the strong negative momentum, we're probably going to run the 62s and maybe even end up at 61.50 before you have a sort of a washing out area. This spike low here at 61.62 is probably going to be the operating point at which the longs are going to probably want to step in. There's definitely a much stronger fundamental case to be long cable than there is to be long euro. Therefore, declines in cable are a little bit more problematic than in other words, if you're looking for bargain hunting against the dollar, this is probably a much better bargain hunt than the euro is in terms of having a fundamental wind at your back and protection. So between here and 6160 could be a really interesting area for bargain hunters for cable to see if we could just have a short snapback rally towards the 63, 64s as the week progresses. On the commodity dollar side, a lot of interesting things are going on. Let me just actually, well, no, let's start with the Aussie. The Aussie continues to get decimated, but what's interesting about the Aussie here, and we did come into this 87.55 area, which is a very, very key support area here. Basically, I think if I have to go out, let me see if I can zoom out. I have to zoom out considerably here. Let me see if I can zoom out. Actually, you know what? Let me go on the weekly basis, and you can see this a lot better. On a weekly chart, you can actually see that the support here on the lows here was around 86.75. That's the absolute dead low of the year, and certainly that means there's basically another 50 to 75 points worth of downside action in the Aussie on the weekly basis. Look at this, by the way, on just the weekly charts. It's kind of interesting. Let me just see if I can zoom in on you. Just these massive declines over the last 3 weeks. I think some of the largest declines you've seen. That's a very, very sharp drop. 3 weeks in a row of negative trades like that in the Aussie, very, very rare. And you can see that, typically, 2 or 3 weeks of movement in one direction necessitates a pause and a correction in the other direction, generally in the Aussie pair. So given the fact that we've corrected, what is it, 94, literally 600 points, maybe even 650 points over the last 3 weeks, some natural snapback could be due here. This has been just a one-way trade. So bottom line here, I think it's an interesting possibility to start building longs at around these levels all the way down to 86.50. Basically, the next 100 points as a potential for a snapback rally in the Aussie. Let's go back to the daily charts here. The other big down move, of course, was the Kiwi. The Kiwi got dragged down in a very interesting fashion because the Central Bank of New Zealand basically threatened intervention without actually doing any intervention. And you see that the Kiwi just also completely broke every single level. On a technical basis, all of this looks like a runaway train. Basically, when you have these massive down moves like that, certainly momentum is accelerating. But at the flip side of this chart is also that you just have basically completely washed out moves. That is, momentum is most of the move effectively has already occurred. The huge amount of panic selling that you're seeing has pretty much occurred. And therefore, again, it probably presents a relatively interesting, albeit a very short-term, snapback bottom here in the Kiwi as well as in the Aussie. The Kiwi remains more vulnerable simply because of this intervention threat. But generally, the Kiwi actually is yielding better yield than the Aussie. All of that has to attract some carry traders at some point because the value proposition on an actual basis, on actually payback basis, is still relatively clear. Especially, and this is what I think is most interesting. This whole destruction of price has been based effectively on the supposition of the market that U.S. rates are no longer going to be zero, and you're going to have a readjustment in the yields, and therefore make U.S. credit more attractive as its yields begin to go into a rate hiking cycle. What if that assumption is actually, if perhaps not false, but much more delayed than the market thinks? What if the yield hiking cycle doesn't even begin until the second half of 2015 rather than the first half of 2015? Then clearly the reaction here becomes quite overdone. Now, when the market begins to realize that is very difficult to gauge, but that would be the primary reason for why you could have a short covering rally here in this whole trade. Bottom line is, for now, having sold so hard, so fast, you almost have to come in here and try to see if you can make a little bit of bid here. But caution you that when you have one-way markets, you can completely get steamrolled over. But that's what we do. We have to get paid for risk. You cannot assume a position if you don't assume risk. And certainly at this point, assuming risk 500-600 points down seems to be a better probability trade than it was earlier. Lastly, let's take a look at dollar CAD. And CAD is actually trading better than all of the other calm dollars. It's not nearly as extended. 111 is a big area, but this 112, let me just go back on the weeklies. You can see that the 112 is the real resist area here. and that has not been breached. So in some ways, the Canadian dollar is a stronger common dollar currency than all the other ones, primarily because it's getting a little bit, I think, a side lift from the North American flow anyways. But again, here also, the fact that you're coming up to these very, very large resist points at 112 suggests that perhaps you also have a very interesting short possibility that you can build from here all the way to around 1300, at which point clearly you would be very wrong. But from here to 1300, building shorts against this double top formation might be an interesting idea. All of these ideas are, of course, contrary to what the price action is saying, but they are driven basically by the assumption that the dollar rally may have gone too far too soon at this point, and that we may have, at very minimum, just sort of a short-term correction over the next couple of weeks. If I'm wrong, the risks are relatively minor because you're very, very close to stop-out points. But if I'm right, the corrections could be relatively significant. From the fundamental point of view, the best counter trades, of course, is in the dollar, is in the pound, because the pound is the strongest fundamental trade. And also, ironically enough, I think technically what looks weakest against the dollar when you look at it is dollar yen, simply because the momentum has stalled. And here again, we have, this is a weekly chart, and you can see the dollar yen can have a very, very strong trending move. But generally, the trending moves tend to be around 500-600 points, right? So here's a trending move that's like 98 to about 105. It's 700 points, right? And this move is 102 to 109, which is another 700-point move. Therefore, the probability of just a pause and a correction looms large. So standing in front of the 110. Given the fact that 110 is a huge resist level from 2008, might be a relatively decent trade here in dollar yen for the next week coming. Wishing you guys the best of luck, the best of trading. This is Boris Schlossberg, over and out.